So we're going to move on to talking about transportation and travel expenses. These are two different things, transportation and travel. Travel involves an overnight. Transportation is just like day to day. So like you, maybe you're a bookkeeper and you have an office and you go out to visit clients during the day, go to update their QuickBooks, come back to your office. That is transportation. It's day to day type of transportation expenses. Travel, like I said, involves some sort of overnight stay. So maybe you're going to a convention or something like that. So transportation is local. Travel usually is like away from your local area. Both types of deductions or both types of expenses are deductible. But again, there are special rules for each of these. So you can take a deduction for business transportation expenses from one place of work to another, as long as the expense is not for commuting. Commuting is when you're going from your home to your workplace. So any drive between your home and a workplace is not considered to be a deductible expense. And by the way, none of it is deductible if you're a W-2 employee. This only applies to people who have their own business, right? People who own a business. These costs, though, could include travel by air, rail, bus, taxi, car, any kind. So even air travel could be considered transportation if you are, like, let's just say you're some executive who works in New York City, but you live in New Jersey and you have a helicopter and it takes you over to New York to your place of business. So that would be by air. In that case, you're probably a W-2 employee and you probably aren't going to get to deduct any of that. And if it's for just getting to your home, to that workplace, it's commuting, so it wouldn't be deductible anyway, but just an example of how like a daily air travel might be included in that. So in order to determine this, you do have to determine what your tax home is. Sometimes that's actually can be kind of a complex determination to get to, but the tax home is the taxpayer's regular place of business regardless of where they actually live. Okay, so that would be your tax home, and travel from your home to that tax home is not deductible. So let's see here. Oh, this is just an extended example here for Allen and Sheree Masters. All right, so the depreciation form, by the way, and I'm hoping that we'll have some time on Thursday to go through this because this is part of your tax return problem. This form can cause some consternation. This is where we put all of our 179 expense, bonus depreciation, maker's depreciation, all of that stuff that we just went through in that section goes on this form, the 4562 form. And we'll talk more about that on Thursday. You'll see, one thing I want to point out, you'll see, so you've got a line. This is for all property that was placed in service in this year. If it's from a previous year, it does not get itemized like this. Previous year depreciation or depreciation that is resulting from assets that were placed in service a previous year gets placed, what line is it? There we go. Makers deductions, assets placed in service for tax years beginning before 2024. So all of the depreciation for assets that were purchased before that you still have on the books that you're still depreciating, that gets lumped in there on line 17. This is just for property you placed in service this year. So you can see we've got all the different recovery lives, class lives here. And there's our recovery period listed. What's our convention that we're using? What method are we using? Double declining balance, 150%, straight line, yada, yada. And then the depreciation deduction amount there. So like I said, we will go through that. So this one, listed property, has its own section. So there's, what we just went through. So here's an automobile. So again, property used more than 50% in a qualified business use listed here, property use 50% or less in a qualified. So you've got them separated out on the form, more than 50%, less than 50%. This is the business use. This you have to keep track of the miles for every vehicle, how many miles you're driving it for business and for total. That gets listed there. What else? Oh, amortization. We don't really get into that, but that's for non-tangibles. I just wanted to kind of show you that. Okay, so transportation expenses. Let's get back to transportation expenses. A little sidetrack there to show you that form. This can be a really helpful infographic, by the way. I find it very, very helpful. This tells you when transportation is deductible and when it is not deductible. So, for example, we've got home. If we're going from home to our regular or main job, it is never deductible. That trip is not deductible. That's your commuting. If you're going from home to a second job, that is also not deductible. Doesn't matter how many jobs you have. Driving from your home to whatever job is not deductible. Driving from your home to a temporary work location. That example might be those, like I just used the example of you're a bookkeeper and you are going to a client to work on their books. That's a temporary work location. It is deductible if you have a regular or main job at another location. So if your main job, though, is out of your home, then that would not be deductible because you're essentially commuting. You're going from your home. But if you had a main job that was, or say you had a main office like in downtown, but you're going from your home to a client's office, that now becomes deductible because you have a regular or main job at another location, right? If you are going from a temporary work location to your regular job, that is deductible. That's going from your office downtown to a client. That's from your main job to your main location to that secondary location. That is always deductible. Going from your regular or main job to a second job, that is actually deductible. So from that main job to, it's just when it's involves your home, then it's not deductible. Okay, so it's always the recommendation, if you want to deduct that, make sure you stop at an office first and then go to wherever it is that you're going. So like I said, this is for transportation expenses that you incur day to day in your job, but not your W-2 job. Just if you are through the business. So these are what's deductible to the business. So local transportation is deductible, getting from one workplace to another when traveling within the city, visiting clients or customers, going to a business meeting away from a taxpayer's regular workplace, getting from home to a temporary workplace when the taxpayer has one or more regular places of work. Temporary workplaces can either be inside or outside the taxpayer's tax home. So we've got Catalina, self-employed computer analyst in downtown Atlanta, maintains an office at downtown, lives 30 miles out of town. She's currently performing a job that will last approximately a week, 45 miles on the other side of Atlanta. So 75-mile one-way trip from her home. Because it's a temporary work location, she can deduct the cost of her transportation from her home to the temporary location, only because it's a temporary work location. Same facts, however, every morning she goes to the office for 2 hours. In this case, only the cost of her trip from the office to the temporary workplace is deductible because going from her home to her regular office is never deductible. So in this case, because it would be considered commuting. All right, so what do we deduct? So for automobile expenses, there are two ways you can take deductions. One is using the standard mileage rate. These are auto. First one, standard mileage rate. In this rate changes every year. In 2024, it was 67 cents per mile. So you have to keep track of your mileage. You have to have a log, what they call a contemporaneous log. So you have to keep that. You can't just create it at the end of the year. You have to keep it as you go. So, and a lot of times there are apps now that will do it. You just press the button and it tells you, you start it, and it, through GPS, determines how far you went. You want to put in what your purpose was for that trip, certainly, but it will keep track of what that mileage is. You need to know the mileage, both the business mileage and the total mileage, regardless of which method you're going to use. It's just that this is pretty easy. All you do is keep track of the mileage and then you multiply it by that 67 cents. So if you drove 1,000 miles per year in a year for business purposes, 67 cents a mile, you get a deduction of $670. Pretty substantial. What this standard mileage rate does is it encompasses oil, gas, repairs, depreciation, those types of expenses. It wraps it all up into a per mile rate. In addition, if you're going to use this, you can also include parking on top of this. Tolls, interest. So if you bought your car and you took out a loan on it, you can include the interest expense, but it's in the proportion that you used it for business. So if your total miles for the year were 10,000 and you used it 5,000 miles for business, that's 50% business use. You could take 50% of the interest. Additional registration fees. Those additional fees. So taxpayer can use this if the taxpayer owns the vehicle and uses the standard mileage rate for the first year it was placed in service. Taxpayer leases the auto and uses that for the entire lease period. So you have to use it, you have to have used it for the first year in service. You cannot use it if you have claimed any depreciation other than straight line. Usually we don't. If you've claimed any depreciation, we don't take it. If you've claimed any 179 or bonus depreciation, because that makes sense, right? Because it's already included. It's baked into the per mile rate. You also can't use it if you have 5 or more cars at one time that you're using in your business operations. So if you've got a fleet of cars that you're using, you have to use actual expenses, because that's the second one. Second is actual expenses. So this is just itemized expenses, which includes all of these things. So you depreciate the vehicle, you keep track of what your oil, your gas, your repairs, all of that stuff was. You keep track of all of that and you take the actual expenses. So the benefit of the standard mileage rate is you don't have to keep track of all that stuff. You don't have to keep every receipt for the gas that you purchased or keep track of the oil changes or the repairs or anything like that. You just have to keep track of the mileage and your usage and what what your purpose. You got to keep that log, that contemporaneous log of all of your business use. So as it mentions here, you can still deduct the business portion of any interest paid in acquiring the vehicle, other permitted deductions, parking fees, tolls, property taxes. That's what I mean by the registration fees. If the vehicle is used less than 100%, the business portion of the property taxes should be reported on Schedule C. So if it's used, say it's used 50% business, 50% personal, and your registration, your property taxes on it every year are $200, then you're going to take $100 on the Schedule C as an expense under your vehicle, you're going to take $100 on the Schedule A. You're going to apportion that between the two. Let's see. That's just an example. I'm looking at the time here. We've got 15 minutes left, and I want to try and get through this as much as I can. So this is just an example of somebody who used their vehicle. They drove 14,000 business miles during the year, so that deduction was $9,380. That's a huge amount. That's a pretty substantial deduction. Interest, they get to take 60%, so they determined that 60% of their usage was for business. They say that up here. Interest was $1,600, so they get to take 60% of that as a deduction. Property taxes were $180, so they get to take 60% of that. So this is the total amount of deduction that they're going to get on the Schedule C for their business use of this vehicle. The additional $72, or the difference there, that $72 is going to go on their Schedule A if they're itemizing their deductions, right? If they're not itemizing their deductions, they're not going to put it on that Schedule A. But if they're eligible, then they would put that amount on their Schedule A. So that's standard mileage rate. Actual expenses, we're going to itemize everything out. We're going to take our depreciation, our lease payments, interest that we're paying as well, gas, oil, repairs, insurance. So this also assumes insurance. That's encompassed in that 67 cents a mile. And they change this every year. So the 67 cents a mile changes every year. They analyze what it's not only affected by gas prices, it is affected by gas prices, but it's affected by insurance rates and all different kinds of costs that are embedded in that 67 cents a mile. I think right now it's 70 cents in 2025. I don't know what it's going to go to. It very rarely goes down. It has gone down, but usually it just goes up. Like cost of everything else usually just goes up. So what else do I want to say here? If a taxpayer used the standard mileage rate in the past and decides to switch to actual expense, they have to use straight line depreciation, and they have to reduce the depreciable basis of that vehicle by 30 cents a mile. So they're essentially taking that depreciation portion out of the calculation. So you can switch to using actual expenses, but it's gonna affect how much you can take. So actual expense, and they say here, actual expense method usually results in a larger deduction, but it also requires receipts for actual expenses. That's not necessarily the case. It depends on how old the vehicle is, right? If you've got a vehicle that cost you $8,000, and it doesn't require a whole lot of repairs or anything, then the mileage will probably get you a bigger deduction over the life of the vehicle. If you've got an expensive vehicle, then that depreciation deduction is going to get you a bigger deduction. Okay. So this is under transportation expenses. Again, day-to-day travel, no overnight. Okay. The next area are travel expenses.